With more, we have Marta Norton, Empower Chief Investment Strategist. Marta, it's great to see you, especially on set. Let's talk about areas you would trim. And one area you would trim, Marta, would be AI. How come?
Yeah, it's really that AI theme that's been such a driver of the market overall, and of course of the name specifically, technology as a sector in particular. And when we take a look at where valuations have run, of course they got cheap on April 8th, but that was just a momentary stretch of time, and then we've been back up to these very high valuations. And of course, as soon as valuations come up, everyone says valuations are not a timing indicator.
Right.
Except when they're at extremes. And when you take a look at when they're at extremely expensive levels and extremely cheap levels, that's when you start to see them become predictive of 3-year returns. And so at these levels, you could argue that we could see weaker prospective 3-year returns in areas that are at these extremes. So that's on the list.
What do you think more broadly, Marta, as just someone who's been studying the markets a long time, the kind of AI spending bonanza, which has investors so excited? If you're a company, you just have to say you're going to spend, and people bid up your stock.
That's right.
The dollars being talked about, they're historic, right, Marta? And I'm just wondering, do you have confidence in that, and think, you know what, it's all going to work out? It's all going to, in the end of the day, it's going to generate real material revenue and profits. It's going to be fine, or no? Or do you have concerns? Where do you land on that?
Well, as we think about the AI theme, there has been some encouragement this year that doesn't just relate to the CapEx spend. So if we're looking specifically at the hyperscalers, and we're looking
those cloud giants,
and you're looking at the cloud revenue that they're generating, it's been a pretty meaningful step upward. A lot of it related to customers running AI workflows on their infrastructure. And so that's a sign that there really is demand from the broader economy that gives credibility to AI. But when you're talking specifically about the AI spend and this idea that even just the gesture of putting a ton of money behind AI is something that investors are really enthusiastic about, that should give us a bit of pause, because we know that
because it indicates what to you, Marta?
Well, capital expenditures, especially at these high levels, can go awry. They're not necessarily always, perfectly sized and in the perfect direction. And in fact, historically speaking, when you've seen big CapEx cycles, a lot of those companies are penalized. Think energy companies, think some of the telco companies. It can be an actual burden for some of these companies. And so there's a lot of expectation in the market for them to get these investments right. And that's not always the case.
So if I'm trimming AI, Marta, and I'm rebalancing my portfolio, what am I rebalancing into?
Okay, so there's not a ton of valuation in the market, or valuation opportunity today. And so it's not just technology that's at these peak valuation levels. It's also areas like industrials, financials, areas that make up the value end of the spectrum. There are only 2 exceptions, at least in the US, and they relate to healthcare and they relate to small caps. Now, both of these areas have real problems. It's not as though it's, a perfect story for either of them. When healthcare, you have policy concerns. With small caps, there's a weight from tariffs, there's questions around the economy, and they're very economically sensitive. But that's somewhat in the price for both of them. So if you're looking at how do I find value, how do I have a little bit of that valuation exposure within my portfolio, healthcare and small caps are 2 of the places that you can hunt.
There have been strategists on this show, Marta, banging the table on small caps.
Yeah.
And I guess their thesis really just comes down to, hey, I'm betting they say the economy looks to be hanging in there, and Powell's cutting.
I think the argument too, of course, small caps have more debt exposure than some of their larger cap brethren. So the argument being that if we start to see rates come down, maybe that improves their fundamentals a bit. And if the economy stays strong, you also have their economic sensitivity that should help lift them up a bit.
I mentioned Powell. What did you think? Our Fed chair was talking stock prices. You saw this, and he said, fairly highly valued.
Yeah, it's
what do you make of that?
I don't know, maybe he's just been talking to his broker, but he's also saying something that I think a lot of people are echoing. You hear that on
things
almost
feel stretched?
that things feel stretched. I mean, people are running, and I hear people, there's a lot of justification for it, of course. We've had very strong earnings. There's a lot of even fiscal stimulus, putting tariffs to the side, but you have the One Big Beautiful Bill Act, the 100% expensing, you have deregulation, you have, healthy debt levels for at least consumers and for for businesses, not so much for the government. So I think people are saying, where's the problem spot? I don't see one. And I guess my point is that with valuations, it's like operating with a low immune system. It might not necessarily be a risk in and of itself, but it doesn't give you a whole lot of protection from the risk when valuations are this high.
And those who stay long the market, Martin, they'll come on here and say they acknowledge things feel stretched.
Yeah.
And I guess what they'll say is, okay, we're stretched, but they'll say earnings are solid, the economy is resilient, and Powell's cutting.
That's right. That's right. And all of those things are very much true. I guess I would also say they're all in the price. So if we're thinking about what drives stock prices, of course your income, and then you're looking at earnings and you're looking at valuations. Valuations can expand here. They were higher at the end of 2021, but they're definitely at the higher end. And so there's probably less room for expansion here than maybe there was on April 8th. Earnings could drive it forward, but they would have to be pretty solid because people expect good earnings at this point.
The Fed cut by 25, was that the right call in your opinion?
Well, I certainly didn't want to see a half percentage point cut.
You didn't.
I did not.
Dr. Myron did.
I know a lot of people wanted to, but I guess what I come back to is when you think about the framework that Powell and other central bankers lay out. Mario Draghi said, small steps in a dark room. You don't want to engage aggressively on monetary policy unless you're in a crisis. So to me, a half percentage point cut would either say that they made a mistake, at the prior meeting, which is a possibility, or it would suggest that we're in a crisis. And I don't think our labor market, at least with the data we have thus far, is crisis data. And of course, there's inflation.
We're debating now what the pace of cuts looks like ahead. How dependent is the stock market on those cuts?
We have seen over this cycle the market be ahead of the Fed almost every time rate cuts are a topic of conversation. And the market has had to come back to where the Fed is. Despite that, it hasn't necessarily unraveled the market rally. It's just been kind of this recalibration. So I'm not sure that a slower pace of cuts would necessarily unravel the rally. I just don't think it would fuel it anymore.
Marta, great to see you, especially on set. Thanks for stopping by.
Absolutely.
Well, Nvidia is investing up to $100 billion in OpenAI, with the first $10 billion coming right after the deal is signed. The chip giant will support the AI startup's data center buildouts with at least 10 gigawatts of power capacity and equipped with Nvidia's advanced chips to train and deploy AI models. Joining me now on this is Sultan Medji, the founder and CEO of Frontier Foundry and former chief innovation officer at the FDIC. And I want to start on this deal, your reaction to it, and how this maybe sets us up for the future of AI infrastructure.
It's definitely one of the most interesting capital investments we've seen in a while, and hopefully will help scale this up in a way where the overall price to delivery goes down. OpenAI's infrastructure set is starting to get a little old compared to other players in the space. So this is a big investment, a big vote of confidence from Nvidia, which obviously makes up the vast majority of OpenAI's infrastructure, and hopefully gives OpenAI the opportunity to continue to find that revenue that they're missing right now.
And so it's interesting because not everyone has been swept up in the optimism. We heard from one analyst, D.A. Davidson Galoria, who said that Nvidia is acting as the, quote, investor of last resort, bailing out OpenAI's extended commitment. So do you view that as a red flag at all?
Well, there are kind of two different red flags, or I'd say at least yellow flags, that are in my mind right now. The first is that we're exiting kind of version one of this generative AI market, and we haven't seen someone hit that Google moment or that iPhone moment where the revenue just geometrically goes up. The second is we're seeing a big separation between enterprise and government utilization of these technologies and consumer utilization of these technologies. And so as the market matures, you can continue to see this kind of fragmentation happen, and newer companies that are more focused, more narrowly defined relative to enterprise value, are doing far more with far less money.
And far less money. According to Bain, there's a new report that AI companies may fall $800 billion short in revenue by 2030, given current monetization rates. So is Nvidia the only one that's making money in this space right now? I mean, when can we expect the others to catch up?
It's a great question, and frankly, right now with this version of the GPU technologies that Nvidia is getting everyone to use, which is in their own best interest, right? Buy my chip and then rent it out to everyone else. It's a great way to alter the spreadsheets and make sure that you're still making money. Everybody on the other end is going to be racing to the bottom in terms of commoditization and trying to get those prices down as much as possible. So, 2 years from now, I would expect to see this market radically altered. And I think a lot of the big data center projects are never actually going to get fully, built up to fruition because this technology is evolving incredibly rapidly, and needing a GPU to run a transformer, which is really what this is about, is no longer required. You can use CPUs, you can use alternative chipsets, and all of that other innovation is coming very rapidly.
And what are the implications of that, Sultan, if we do see that extremely altered landscape from where we are right now?
Yeah, I mean, for the last couple of years, we've seen a massive concentration in venture capital and capital investment in a very small number of companies, while there are thousands of other companies out there that are doing incredibly interesting, high quality work in artificial intelligence on smaller scale infrastructures, whether it's a laptop in some cases, or an iPad, or a single server sitting in a desk, these edge compute use cases. We're going to end up seeing this bifurcation of the market from one version where it's all big GPU farms for very specific large scale use cases, but the enterprise value is probably not going to come from that. It's going to come from people who are using smaller scale infrastructures to drive process optimization, to drive lower costs, to drive better bottom lines, to get to market faster. And I think at the end of the day, the question I wonder is OpenAI, the next Google, or is it the next Ask Jeeves?
So as an investor, what should you be looking at? Should you be looking at some of those smaller players and maybe not focusing so much attention on the big shiny objects like your Nvidia?
Yeah. I have always focused on what's the ROI. Are you going to end up being able to invest in something that will drive a return on investment that justifies the amount of money you're putting in? Right now, there are a lot of companies out there where the ROI is far more straightforward, and there's a far more linear path from I put $1 in now, I get $7 out in a few years. And so, a lot of these bigger, kind of pre-COVID or through COVID AI companies just are very expensive. And frankly, it's not clear that you'll be able to get your money back. Nvidia is always going to be a different case because there's just so much demand right now. But 2 or 3 years from now, I'm not sure that's necessarily going to be the same.
And finally, I want to end on what I've been ruminating on, which is this flywheel of investments. Nvidia, Intel, Nvidia, OpenAI. You have OpenAI, Oracle. What do you make of what's going on in this space right now when it comes to sort of the pockets of money changing within this same circle?
Well, when 70 to 80% of the investment capital expenditure that people are talking about is locked into less than 20 companies, it's really hard to see anything outside of that, right? That little bubble, and you just did a great job explaining it, is this nice little bubble, and all they're doing is trying to keep it moving until they can get enough enterprise revenue to justify the amount of money they've put in yet, and that's not happening at the pace that everyone wants. That little bubble you just talked about is not an area that I find, frankly, that interesting from an investment perspective. And so much of the very interesting technology that's being developed right now is outside of that bubble as well. So if you're really thinking of that bubble is going to be there, but it's sort of like saying, AWS is going to be there or Azure is going to be there. Well, of course they are, but is that necessarily going to be your high growth market, your high innovation market? I think there's some question there.
Yeah, a lot to keep tracking in this space. Sultan, thank you so much. Appreciate your time today.
Thanks for having me.
Well, big AI names took some losses during trade Wednesday, with Nvidia and Oracle recovering pre-market after both closing lower. My next guest says announcements of major deals between those companies and OpenAI could be fueling what he calls a potentially epic bubble. Joining us now is Joe Hagener, Asterozoa Capital CIO. Joe, thanks for being here.
Thanks for having me.
So it's been really interesting to follow this AI trade. We've seen, as I was talking about earlier in the show, sort of the waxing and waning of sentiment, right? This is going to be the biggest thing ever. How could it possibly be? Oh, all these companies are spending money. They're spending too much money. So it seems like we're in another one of those waning or at least questioning phases. Is that fair to say? And do you think it's valid to question the whole structure of the thing?
Well, I definitely think it's valid to question the overall structure and the phenomenon that's taking place. We're drawing a lot of similarities between what's happening now and, of course, .com. That's not necessarily a new reference. But the thing I think is particularly interesting, right, is just the timing of market bubbles and what brings them to a halt, I suppose, right? The .com era, the only thing that really popped or burst that bubble was the Fed raising interest rates, right? And kind of that led to the epic crash. But for years, there were commentators and professionals and analysts from 1995 all the way to 2000 that were pounding the table saying, we're in a bubble, we're in a bubble. And they were right. But if you got short in 1995,
Right.
you didn't exist by the 1999, and you missed out on 40% plus equity market returns for years to come. And so that's the interesting thing I think that's taking place now is I definitely think we are in a bubble. And so, what do you do at this stage, right? Because we just cut interest rates. And we're looking at cutting more, and there's fiscal spending coming down the pipe.
Right, so there's nothing externally necessarily that would burst the bubble.
If anything, I feel like we're about to pour some gasoline on the fire. And so that's what gives us a little bit of pause, because I definitely think the left tail scenario, the risk to the downside is immense, because by any measure, valuations are very stretched. We're seeing all sorts of these circular deals that we saw in 1998 and 1999 with some of the same players as we're seeing today. And yet it's very difficult for me to actually get bearish right now, because there are so many positive catalysts as it relates to kind of pushing this sentiment towards more extreme levels.
So, and you're on the credit side of the equation, right?
Mostly on the credit side, yes.
So how do you then play it? I mean, and you mentioned some of the same players like Oracle, which, experienced the bust in the .com era, but they're still around and they're back and they're bigger than ever. Like, do you go in, we just talked about their bond sale. Do you go in and, is that an attractive offering?
Well, I would argue absolutely not, but it's just not necessarily anything to do with Oracle. It's just a function of credit spreads broadly right now are near the lowest they've ever been in history. And it does look like we're seeing some macroeconomic deterioration in jobs data and things along those lines. And a $15 billion investment grade issuance at SOFR plus 40 basis points is just not compelling to us.
I want to just translate that for people who are not steeped in the credit market. So basically, you are not getting paid
exactly
as an investor to make these investments right now, is another way to put that.
You're getting paid, yes, exactly right. You're getting paid 40 extra basis points per year in yield over treasuries to assume the credit risk of a corporation that could not exist in 10 years from now. And it's very difficult to say. I mean, if you asked me or any professional in 1995 if you thought BlackBerry was going to be around in 10 years, I mean, most people would probably say they'll for sure be around. And there's all sorts of things that could happen over the long haul. And so when you're thinking about credit risk in particular, you just want to be a little bit more discerning. And so the way that we're kind of looking at that or playing that is we're actually playing mostly on a relative value basis. And so we can buy credit default swaps that effectively would be you'd be short the credits that you don't like.
So you're basically buying insurance against the company defaulting on its debt at some
Exactly. The beautiful thing about that instrument is that the lower credit spreads go, the smaller your insurance premium is for the protection. And so as they get lower and lower and more compressed, it costs us less and less to buy them. It's that old saying, right? Buy insurance when you don't think you need it.
And so how do you end up making money on those then?
Well, it's a relative value. That's a great question, right? So if you give me $100 and I buy $100 worth of bonds and the yield on that is 8 or 9%, I'm happy to take 1 or 2% per annum of that to purchase protection on the credits that I don't like.
Gotcha. Okay. So that's how you're looking at things right now. How does what the Fed is doing, how does that feed into all of this?
Oh gosh.
In 20 seconds. No, I'm just kidding.
So I think that there's an enormous amount of risk over the intermediate to longer term as it relates to the shape of the yield curve in terms of the polarity that seems to exist within the Federal Reserve right now. There are a handful of people, and I'm kind of in this camp too. I think it's very hard to argue that financial conditions are tight when crypto's going parabolic and equity markets are all-time highs, and there's What did Powell say in his presser the other day? It was effectively Greenspan's version of irrational exuberance. Stock valuations are elevated, I think he said. The jobs data, while deteriorating, it's unclear to me how much of that is a function of efficiency and productivity gains, right? If I'm a law firm and I don't need the 100 analysts anymore because I have AI embedded tools and I don't hire as much, I'm immensely more productive, and my equity value is actually going to be significantly higher, but the jobs data is going to be weaker. Right? And so there are structural changes that are taking place in the economy that could lead to weak economic data or weak jobs data, but it doesn't necessarily imply that changing the interest rate at the Federal Reserve overnight rate is going to do anything to adjust that or fix that. If anything, you're just going to pour gasoline on that fire.
So you think there's a risk to them continuing to cut rates?
Yes. Definitely, and I think we'll see that. And if that is correct, we'll continue to see the yield curve steepen, the long end of the curve start to go higher and higher as the front end comes down.
And that also, to your earlier point, maybe extends the bubble even further.
Yes, I do, and I do also think if the long end of the curve continues to march higher, we'll see some sort of yield curve control via Besant or maybe even the Federal Reserve, who, Trump's going to install the new Fed chair in not too long of a time from now. And he's already had significant influence on, who the Board of Governors are.
Right.
And so it could be a very different Federal Reserve in a year from now than the one we're seeing today.
And just briefly, yield curve control, what would that look like?
Well, there's a number of ways to play that out, but effectively, right? But there's, a government or a central bank would implement that if they don't like the trajectory of long end interest rates, right? The Fed can only control the overnight rate, and then the rest of the curve is extrapolated out via markets. But you can take a bazooka and go buy hundreds of billions of dollars worth of 30-year Treasury bonds and force the 30-year rate lower. You could also, and they've already mentioned this publicly, you could deregulate the banks to where you could encourage or facilitate the large banks in the U.S. to be purchasers of long-end Treasury bonds to increase demand, to lower interest rates. So there's a number of tweaks, and if anybody's going to do it, Scott Bessent is the guy. He understands capital markets so well that if he wants lower rates, I'm not necessarily going to bet against him because he's got a lot of levers at his disposal.
I just think it's time to put to bed this constant fear that the AI trade is peaking. It's done. Every piece of news that we've gotten the past 7 days has been positive.
Yeah, there's definitely a fear that that's what has been almost the sole driver of this market going higher and higher. And so there's this concern that, are we going to get some of the positive sentiment behind AI? Is that going to pull back? And that's going to be bad news for the equity market. But like you're saying, there is support here. One of the things I've looked at is when you talk about the CapEx with these companies, I was concerned about free cash flow. We have seen that come down a little bit, but earnings continue to support these companies. And so I think when you see these deals being made, when you see the CapEx that's there, when you see earnings support the numbers that are coming out, then I think you have to kind of ride this train and go along with it, not bet against it right now. Nvidia is our largest holding and our large cap core strategy, and it's that for a reason. So I do think there's more room to run here, and you want to make sure you have exposure to some of these names in your portfolio.
Victor, let me, as the kids would say, double click. I'm going to double click on what you just said about Nvidia. What other names, if you own Nvidia, what else are you invested in when it comes to AI? And do you need to own a basket of AI stocks when you can own Nvidia and just have that pure play that is seemingly crushing everyone else?
Okay, so it does make me a little bit nervous, Brian, when we want to put all our eggs in one basket for that. So from a pure diversification standpoint, I would say you want to spread that out. But look at the deals that are being made. I know we might talk about that a little bit more later. So I think there are other opportunities that you can have. We have exposure to Broadcom. We have exposure to Qualcomm. We have a little bit of Lam Research in there. There's some other elements within that space that we have exposure to. And I think you want that. It's not Nvidia is going to be 100% of the game going forward. So there's other opportunities. And as we know, as Nvidia continues to do well and builds things, it does lift the rest of those stocks as well. So I think there are more opportunities, but it is our largest holding in that space.
It's almost we're at the point where And as a former analyst, I can't believe I'm going to say this. Maybe you just ignore for right now some of the valuations on these AI names.
I'm going to plug my ears on that one.
Yeah, because I know, me too. And it's like you just ignore some of the valuations on these names and ride momentum, because that's what we're seeing in the markets.
Yeah, look, I mean, you've seen an incredible run with Nvidia, with Micron. Look at what's happening with Alibaba. Some of the commentary about Micron was basically the outlook blows out even the highest of expectations. I mean, this just all bodes well for the AI industry as a whole, and the bullishness that Wall Street has had with the AI industry. And I will also comment that, I was looking at some commentary from UBS about AI and the AI infrastructure growth, and they are looking beyond that. They are saying, look, not only does, for example, earlier this week, the Nvidia OpenAI deal, I know that you'll probably talk about that as well, but look, that has also bled into the need for power, for electricity. So you even saw this week also stocks like Constellation Energy and Vistra, the nuclear theme as well, because this entire AI generation is not just touching the chip stocks. It is also touching the entire industrial industry. It's also touching utilities. So there's many points to this AI theme.
Yeah, Inez, don't give up the rest of the show here. I wrote a big, beautiful segment on Nvidia later on. I mean, it's like a deep tease. I mean, this is going to be an awesome segment. Brooke, let me get back to you real quick, because you were talking a little bit about Alibaba at the top of the show. If you can, pull up a chart on Alibaba, because I think the market forgot how tethered Alibaba, a Chinese internet e-commerce play, is tethered to the AI trade, because they are.
Yeah, Alibaba this morning seeing a bit of a pop, up about 9%. And when you look at this stock, what we've seen over the recent run-up is really the momentum about how Alibaba is really capturing the key demographic within the China e-commerce market. This is a very digital native consumer. This is a consumer that typically shops majority of time on their phone. They're not going to retail as much as even, of course, the fallback here in the U.S. Now that is a big boom here as well. But this investment, this partnership rather, that they now have with Nvidia really doubles down their intention to win over e-commerce with AI, be the most innovative. But of course, you can't help but think of Amazon and Walmart, those two players who have really doubled down. Walmart recently announcing Sparky, their AI chatbot
Sparky?
as well. So Sparky, I don't know if you've heard of him, but really Walmart, Amazon also getting in on this play. But certainly now Alibaba teaming up with Nvidia, it seems like every time you hear the Nvidia get into the conversation, things just got a whole lot more serious.
Sounds like something we got to toss a milk bone to. Throw back to like 1987, Sparky.
I'm going to broaden it out and talk more about AI. I'm glad you're here.
Yeah.
Because the word circular has been making the rounds. See what I did there? So basically, the idea that Nvidia is investing in OpenAI, but also has a deal with OpenAI, and then Oracle's in the mix. All of these hyperscalers, chip makers, AI companies making investments sort of in each other.
Yes.
So at some point, where's the weak point in all of that?
Yeah, so the concept of vendor financing is not new. It's the scale and proportion. Billions of dollars is one thing, but we're talking about hundreds and billions of dollars of essentially vendor financing for a customer. I mean, even in retail, vendors do flooring for retailers,
Sure.
right? So, but it's the proportionality.
But you also get that. You also, if you think about something like retail, for example, you get that money back pretty quickly. Ideally, right? You finance. You finance selling them the apparel or whatever.
That's right.
They sell the apparel that season, and then they pay you back.
Right.
When is the money coming back?
Well, that's right. And what's spooking investors and getting the conversation going too is people comparing this to .com, right? When you had Cisco, Nortel, you had all these companies financing downstream. And by the way, the internet crushed it, right? We're living in a post-internet economy. We wouldn't be here without the internet, but it did have a crash. The one thing that I was at a .com during .com crash. I saw it, and anything can be put on a spreadsheet to look good. What I think is different here, and the circularity that we have going on, is the downstream impact that we are seeing, right? You and I talked about this in the green room, but Meta is already seeing big advances through their investments, and they're not even looked at anymore as a leader in this. You have Microsoft through their enterprise SaaS products seeing a lot of lift. We did see some green shoots from Adobe in their recent earnings. ServiceNow continues to put the pedal to the metal, and let's not forget, OpenAI, again, you can put anything on a spreadsheet, is supposed to have $125 billion in revenue by 2029, and that's bigger than AWS today. A lot of things have to happen. They almost have to 10x their revenue to get there. There is risk, right? I'm not here to say there isn't risk, but those people and those companies that have done downstream AI right are seeing the benefits of it. As consumers, and let's say consumer investors, we can see, hate to use the word magic, sounds so much like Apple, even though they're not really doing much AI, but with OpenAI and how that's changing. My own small business, I personally have 10 agents that are operating and do things auto-magically for me as well.
Right.
The biggest thing that's keeping us from getting this breakout is mostly for businesses and governments.
Right.
Their data is everywhere, right? Ironically, I'm in town for a conference, a company called Cloudera that does data management, similar to Databricks and Snowflake. Huge increases. That's a precursor to an AI application breakout, is seeing those investments. And we saw it with Oracle, right? The big investment in their data cloud.
Pat, we have to leave it there. I'm so sorry. But I know we'll talk again soon. So looking forward to that.